So yeah, thank you for having us here. We're upriver from New Orleans, Louisiana, where we both live. Although we're pretty active in the venture capital community throughout the central U.S. So everywhere from pretty much Ohio, Chicago, St. Louis, Memphis, Nashville, Louisiana, and then two of our lawyers are actually located in Silicon Valley. So I got started in the venture capital world in the early 2000s. I got involved with a lot of things going on in nanotechnology, which has kind of become an enabling technology in everything from energy and advanced materials to biotechnology and things like that. And I've been fortunate enough to work with some of the greatest companies in the world. And not all of them have been the ones that I worked at when I was in Silicon Valley. So when I was in Silicon Valley, I was at the top law firm there, the biggest firm in the area called Wilson Sonsini. We represented everyone from Apple to HP, Logitech. GoDaddy was an early client before it was public of mine when I was there. And it was a really interesting and exciting experience to kind of be in the epicenter of those kinds of things. But having grown up in New Orleans, been born and raised there, I always believed that it would be a cooler thing if cities like New Orleans and St. Louis, some of these cities that had once had some major global prominence could figure out ways to invite startups to get going in their community and help share in the kind of wealth creation. And I'm a firm believer that in the future, these are the growth markets of the United States. And I think, from COVID disruptions and things like that, we're starting to see even more of a resurgence. But I do think we're entering into the 10 to 15 year mark for cities like New Orleans, St. Louis, Nashville, et cetera. And I have with me here Claire Tilmont. Claire Tilmont works for the firm. She helps with a number of things that we do for startup companies, everything from helping companies manage cap tables to studying the data. We're even developing our own cap table app and some other tools to help startup companies. And I couldn't do any of this stuff without Claire in all the various capacities, and she really is a data crunching machine. We look at a lot of numbers, and we do this for a variety of reasons, but number one is because we want to give back to the communities that we help serve. So again, I think, for me, my lifelong passion and mission at this point is helping people in markets outside of Silicon Valley kind of elevate the way they're approaching venture capital. And one of the biggest ways to do that is by helping people educate, because no matter where I go, in what market, there are a number of folks that kind of will tell you what the market is, but they're not studying it in any real capacity. So anecdotal things are getting passed down, but not necessarily the real facts. Number two, I think that all of the markets that we serve currently on a primary basis, although we're still active in California, we're really trying to help kind of this central U.S. region, the southeastern region, get better at venture capital, attract more investments, help build venture capital funds. And one of the things that we have to do in these markets is not rely on third-party data, which is most of the time inaccurate, but we have to pitch to LPs and funds what's actually going on here and make the case why investment is really important. So I really appreciate you guys having me here. There's a lot of familiar faces out in the audience that I see, and it's really good to see. I've been probably coming to St. Louis for 4 or 5 years now and have been involved with a number of the different organizations, and we love it here. So Claire, you want to add anything?
No, I think you got it.
All right. So I'm going to jump right in here. I kind of gave a number of, a little bit about my background, and I told you a little bit about why I look at this data. So from an ecosystem and market perspective, if you're out here serving an organization that's helping startup companies, we really need to make the case both for your benefactors. If you're a nonprofit, if you're a fund, you need to be attracting LPs both within and outside of the state. And the way to do that is to help show people what deal flow really looks like. If I go talk to anybody in this market, almost guaranteed somebody's going to tell me that there's not enough deal flow here. It happens in every market. If I go to Tennessee and Nashville, somebody's going to tell me that. And if I'm in New Orleans, people tell me that all the time. And the truth is, that's just not true. If you are at a certain type of organization and you're serving a certain subset of companies, say you're at an ag tech kind of accelerator or fund, you're probably seeing a sliver of the universe of deals that are out there. Also, there's a tendency in markets outside of Silicon Valley to exclude a lot of deals that are included in Silicon Valley. And I don't think we ought to do that. So, there might be some people that would take a look at our data, our numbers, and say, those look really higher inflated. Maybe you're including things that other people aren't. I don't think that's the case. I just think that sometimes we're overly self-critical in these smaller markets. We say, well, that's not really a tech startup. That's something else. Well, SpaceX is considered a venture-backed tech company, right? Other kinds of manufacturing and product and service companies are considered those. Root Insurance is an example of a tech-backed startup. It's essentially an insurance company done by mobile apps. So we need to not shoot ourselves in the foot. We need to defend and justify the kind of numbers that we put in here. If you're a company trying to fundraise, you really, I think, most importantly, need to focus on this data, because what tends to happen for a lot of startups is they're reading blogs like TechCrunch or other, maybe they're reading PitchBook data or Crunch-based data, or CB Insights. There are a variety of sources nowadays that give you some indicators about what's being raised. Even Carta, we'll talk about some differences in the way Carta categorizes stuff than the way we do. But more often than not, those data points are not going to be very useful for you in your market. So it doesn't help to know that your friend that moved to Palo Alto was successful in raising a $5 million seed round pre-revenue, because I'm here to tell you there's almost no investors in St. Louis that are going to do that for you. The exception to that are the people that have had massive exits or really late stage rounds before. So there's an exception to every rule, but if you're playing the odds, which is what venture capital is all about, you need to know what the most likely scenario is for you to raise money. I think the second thing I've already mentioned, we've got to paint the company's story, we've got to paint the market and the ecosystem story with investors, both in inside and out. And I think in general, again, I think that these markets like St. Louis, New Orleans, in many respects, Nashville, we're 10 to 15 years out in these experiments. In the Great Recession, we saw a lot of investors get off the sidelines, start getting interested in startup companies. There are a lot more angels than I think ever before in the prior decades. And there have been a lot of lessons learned, some good and some bad. Not everything's worked out. I think we're kind of going through a restructuring in a lot of places. So it's time to sort of elevate the discourse and say, here's the actual numbers about what's happening. We should double down on what's working, just like in the startup context, and discard what's not working. The last thing, I think, is setting realistic expectations, whether it's your founding team and your company, about what your progression of funding rounds actually will probably look like, preparing for the times when capital might not be available, which is as important as preparing for how to use it properly, and then same thing with these ecosystems that we're all a part of, which is how to make these work in a way that makes a lot of sense. So the good news here, people asked me as I was walking in, well, is this going to be doom and gloom, or is there any optimism? I don't know how you can be in the world of venture capital or startups without being a long-term optimist. There are too many ups and downs on a daily basis for you not to be. So over the last 12 years, we believe that there's been at least $3.6 billion worth of deals in over 914 funding rounds. That's a lot of funding rounds. That's way more than what we're seeing, even in markets that have maybe had higher levels of deal activity, like Tennessee. That's a pretty significant amount of deals in terms of numbers of deals. And I think Missouri has a lot to be proud of, and there are a lot of really positive things going for this market over certain others. So first of all, congratulations to all of you that have played a role in that, because that's a tremendous amount of economic activity, and it's really a big milestone. I think that's an important point. I was talking to Claire today. I kind of wish we had, we started really keeping data and scrubbing it from around 2011 on. I kind of wish we had 2007 to 11 data to compare to today, because I have a feeling there's some major similarities. So we might go back to that at some point, but that's kind of when we started looking at it. In terms of the amount of capital raised and the deal volume, you're going to see some things here, right? So obviously, you see 2020 what happened. And everybody knew this. I think that's probably in this room. Then 2020, when COVID hit, most funds put a pause on investment, and they wanted to see how things shaked out. That wasn't true in all situations. So I'm a partner in a fund called Calate Capital Ventures, and we actually had just finished raising money in late 2019, and we began to deploy in 2020. And our belief was this is a good opportunity because a lot of funds are sitting on the sidelines, they're not sure what to do. COVID didn't change the fundamentals, we believed, in the good kind of companies that we were looking at. So we don't look at a lot of companies typically that we believe will be subject to a lot of like market disruption or risk. So, I think one of the lessons I think most active investors outside of Silicon Valley take, as opposed to the narrative that you sometimes read in Silicon Valley, is that companies outside of Silicon Valley tend to be more capital efficient. So it's cheaper to hire people, it's cheaper to get started a lot of times, it's harder to raise as much money, so people have to figure out how to do more with less. So I think there was still deal activity in 2021, but as you all probably know, deal activity kind of slowed down. Things were pretty insane. I think I remember the last time I was here, everybody had masks on probably. Things came roaring back in 2021 in terms of the amount of capital raised, and the deal volume also increased. It didn't go, past the height in 2017 that we're measuring. And for 2022 and 2023, it still has looked pretty good. I think there are fundamental questions about whether or not for the next several years we're going to get to these 15, 16, 17 numbers for a while. I think it'll happen again. I just don't think it'll happen until 25, 26, 27 or later. So if you did expand this, because we do look at a lot of national and other data sets on a longer term basis, you'll see that there's ups, downs, but the long term trend is up and to the right. And that's essentially, I think, what you're gonna end up seeing here. What also happens is, especially in markets that are smaller, you have a core group of companies that are really doing very well. So I'm sure you can think of the examples in St. Louis. In New Orleans, we had between 2019 and 2022, we had almost $2.5 billion worth of exits of companies. And leading up to those exit events, companies were doing very big rounds. So you'd see like $50 million, $60 million plus rounds. And that tends to happen in these smaller markets, which makes the data look like it's going up. And then, we report this stuff, the news blogs and everybody says, oh, deals are down. They love the deals are down stories. But long-term trend, they look like they're probably going up. I think it does look like, and this is consistent with national trend data, that mega rounds have become a little bit more prevalent in some of these areas than they were in the past. So I know like from 2010 to 2015, in any market I wasn't active in, I didn't see really that many $20 to $50 million rounds. Those have become a little bit more common, I think, outside of Silicon Valley. Yeah.
On the 23, is that to date?
That's to date.
It's not an annualized projection?
No.
No, it's still about August.
So this is where we are. Okay.
Yeah, so we think 2023 here, as long as there's a strong, last quarter of the year, 2023 will look pretty much like 2022. So again, already walking in the door, I probably heard a few people say, oh, my God, it's just terrible out there, it's getting killed. But there are still deals happening. I think what's happening is most deals that are happening are follow-on rounds, right? And they're deals already in portfolios. New company rounds, at least what we're seeing anecdotally, are by companies whose founders have raised previously and exited, or who have like a core group of lead investors soothing everyone else's concerns. I think one of the things that are depressing the numbers a little bit, at least in Louisiana, I think here, although I'm not sure, I'd love to talk to you guys in our Q&A in a little bit. I think that there's a lot of funds out there that are trying to get going, especially to claim the SSBCI funds. I don't think that many groups have gotten a ton of those funds in the bank. I think the allocations and things have been announced, but I don't know who's gotten what here. I know in Louisiana it's very delayed. Has anybody gotten?
We have money.
Yeah? Yeah.
We have money.
Okay. Yeah. So it's in the bank. You guys have gotten it released and everything. Yeah.
Yeah.
Okay. Okay. So yeah, I think to some degree, some of the decline. I think a lot of groups are waiting to deploy till they got their capital commitment secured, and then now I expect probably in 2024 we'll see an increase. I also think bigger private funds whether or not they're doing the SSBCI program. One of the things we hear from LPs is that, they want to see, they're still interested in VC investing and tech investing, but they also want to see combinations of things. Like they are to some degree looking at more private equity style deals where companies are cash flowing because money is worth less than it used to be. So I think more than ever in the last 10, 15 years, with inflation, I think people are looking at not just tech company venture, kind of traditional venture, but they're looking at more almost like early stage growth capital investing in companies that have the optionality to generate cash flow if things don't work out. I think that's hedging in an uncertain environment. A couple other notes here. I think we recorded about 90 deals approximately per year in the St. Louis market, which is a lot. That's a lot that's the Missouri market as a whole. 2023 does look like it's on par with 2022, but it just depends on this last quarter. With an election cycle coming, I think a lot of investors sort of indefinitely waiting for the shoe to drop. It seems like, I don't know, it's hard to tell. Another thing I would say impacting the numbers, at least for the deals that we're doing, is we've had more M&A activity in the last 3 years than probably at any other point. So, I think we've been averaging almost 2 M&A deals per month for at least a couple years. And these are, the M&A deals that we're doing are, public company acquirers of tech companies that have, either tech that the public company really wants to be competitive in a market where they're not in, or it's, but really that's been the main driver for the most part, is just companies acquiring tech that, like from strategic acquisitions, like they're already doing work with our clients and using them or partnering on some kind of thing in technology, and they say, well, we should just bring that in-house. And these have been mostly cash deals, although some combination of cash and equity deals. So I think, again, if you're looking at this from, there's 90 companies per year raising money. Some number of them are going to drop off and not continue. A smaller number are going to raise increasingly bigger rounds, which makes the amount of capital raised generally going up. And then things cycle back, companies get started again, especially as those companies exit, new people get going. One of the things that happened in the last recession that we also track is population growth in a lot of different cities outside of Silicon Valley, especially in this kind of central US and South market. And in almost every market that I cover as a VC or a lawyer, you'll see that in recessionary times, the population goes up. And this is a long-term trend as people are moving, I think, more and more out of large East and West Coast cities. And I think that's a long-term trend. I just think that the quality of life and the opportunities actually aren't all they're cracked up to be. So although there are a lot more deals in those markets, if you've lived there and spent time in them and you know the people there, they're actually more closed off, I think, for the most part, than a lot of other markets. If you know what you're doing and you move to St. Louis or New Orleans or Nashville, there's a good chance you're going to get an audience with different good investors and you can get something going. We see that all the time. So yeah, I've already kind of mentioned this. Markets are cyclical. This is one of the. This is something that you just see, like from 2010 to 2014, 15. 2014 and 15, there was a lot of bubble discussion. Things kind of tapered off briefly, and then they rebounded like crazy in 16 and 17. We're seeing things go down. I think with the election cycle, commercial real estate fears, and interest rates high, people are sort of taking a wait-and-see attitude. There's also other ways for investors to make money in things like private lending or just leaving it in different accounts that make good interest versus the very low interest rate environment we were in before. COVID clearly had an impact. There's no doubt about it. But there are more deals happening, I think, than people realize. This is always one of the most important slides to me in our data because, again, I spend most of my time advising founders on how to structure around properly to attract capital. And every time I do this, everyone is sitting with me, we only need like $5 million to do what we got to do and become the leader in the market. And I'm like, I know, right? That's all we need. I would be super happy. I would be super happy if every deal I did was $5 million as a lawyer or an investor. The challenge is they're just not. So, you know, for 4 to 5 years here, from 2014 to 15, more often than not, deals were in the $500,000 to $750,000 range, right? So companies would do a seed one of $500,000 to $750,000, and they would do a seed two of another $500,000 to $750,000. I still think that's the norm, even though the median has crept up here to between 1 and 2. So we'll see if this holds going forward. I think it's trending down as people are being a little bit more cautious and placing more bets, but it's been between $1 and $2 million. And I do think it has increased because compared to 2014, there are a lot more seed and angel funds and investors out there in these markets, or there were from 2018 to 2023. I don't know if that will hold or not. The average deal size gets pushed way up by these mega deals, which weren't happening back then as much. So, you know, the later stage companies in your market are pushing the average way up, but most companies are still raising $1 and $2 million in their rounds. We've done some pretty big seed rounds. We've done some $10 million seed rounds at $70+ million valuations, and they happen. You know, so when you say to me, if you're meeting with me and we're helping craft a strategy to succeed in the round, you know, I know of, and same thing in our Silicon Valley deals, they're sometimes higher. But again, if you're playing the odds, you want to probably go to market at an early stage, like pre millions of dollars in revenue. I think you're going to succeed better adjusting your round size down to $1 to $2 million, being really specific with people with what you're going to accomplish, and then accomplish that, and make sure that those people have enough money to write the second check. Another thing that I hear almost without fail is, oh, this person's coming in the round, they're worth like $100 million, so they could write like whatever. That is not true. Those people with $100 million total net worth do not have whatever to put into your round, believe it or not. If they did that, they would lose all their $100 million. So, you know, if you have an investable liquid net worth of $10 million, you might only devote a sliver of that to this kind of alternative investment. So you're going to be taking your $10 million in a given year and maybe giving, you know, 5 private real estate funds $1 million each. Then maybe you give another fund or another couple funds $1 million. Then you have some on your own personal allocation. So, you know, you need to understand both how the investors do their investment allocations and how funds do their investment allocations to succeed. So, you know, just because you have a person known to you or known to the community to be very wealthy in your deal, the chances are they're not going to write a check more than $250,000. Yes.
Is this including straight equity, convertible debt, and safes? So like
Yeah.
all the different points. So it's every.
Yes. Yeah. This is.
Do you have a sense of the breakdown?
No, I don't.
Okay.
We could look that up. We probably have that. We would definitely have that data in the set, but I don't know it offhand. I'll, you know, what would I say?
So I would say just, and this is not, I could pull it specifically, but just from looking at it, probably like the convertible note safes are in the like 150 to 500 range. I think a lot of the like early stage, and it's something we've talked about at different times, like you see, you know, oh, we want to raise $1 million, but we started off at 500,000. Then maybe we got a little bit more interest a couple months later, and so maybe there's another 200 that comes in, and then maybe we got a little bit more interest later. So, I mean, I think that, I don't know if that totally answers the question,
Yeah,
but.
this is like a breakdown, like percentage-wise. Like if you have like 90 deals,
Oh, how many
5
are?
of those? It seems like the price rounds are getting fewer and far between.
Yeah, I
Yeah.
mean, it's so. I'll give you my perspective on convertible notes and safes and equity rounds. Historically, convertible notes and safes were used to incentivize a round or to bridge between rounds. In the last recession, more and more investors wanted to use safes, especially investors that were kind of connected to nonprofit ecosystems. A, because they thought it was easier, and B, because it was the best of all worlds for investors. So they said, the worst case scenario is I have this cap in there. Prior to the Great Recession, I did almost no deals. I was in the busiest group of the busiest firm in Silicon Valley. We did almost no capped note deals. The recession hit, and all of a sudden, a lot of things were capped. At the same time, more people than ever got into venture and angel capital investing. So for the past 15 years, I've been telling people notes and safes really aren't the norm. They became popularized by Y Combinator and some of the other groups that are out there, but they are investor favorable. So I don't personally do that many convertible notes and safes. We do them for the first $500,000 seed round, because those investors come in, they're like, oh, I'm going to get a discount on some money that's coming in later. It's good to jumpstart around. And then we're seeing more, there are a lot of convertible note and safe rounds happening right now at valuation caps below the last price round, which is a form of a down round, but it's there to trick people into pretending like it's not a down round. So I do think the instrument is increasing in frequency. I don't think, at least the ones that we're advising, are not using safes and convertible notes for large amounts of money. Because the reason when they convert, if you do a $2 million convertible note or safe round and the valuation's kind of low, the valuation cap is low, we're seeing companies at Series A that have sold more than 40% of the company. And then they're essentially untouchable by later stage investors. So I think be careful out there. I think they became a quick fix on the idea of they're cheaper to do. They're not cheaper to do really for somebody that knows what they're doing between a Series Seed, for example, and we'll look that up. And if you want to...
I would say too, again, not specifically or from the data, but there definitely were a lot more later stage rounds and a lot more pre-seed convertible note smaller rounds, and I saw a lot less than typical of that, Series A 1 million to 6 million range deals for sure in the 2021, 2022, 2023.
Yeah, right. We'll see what valuations do. This is an interesting thing. I think part of what's happened here is more education. In 2010, 11, when I look at deals in non-Silicon Valley markets, there was a crazy number of LLCs, and I think people just didn't know the preference for most institutional investors, and they weren't aware of the benefits of things like qualified small business stock, which is a exclusion of gain at exit. So a company doesn't have to pay or each shareholder doesn't have to pay up to $10 million of gain at exit with a corporation. So this has changed by far, in a way, in the venture capital industry. Corporations raise more money, I think, and do more deals than LLCs. I am seeing some weird things happening that, some people are doing LLCs but taxed as corporations, C corporations. I don't know if that's happening here, but I'm seeing other people do that. And I mean, I understand the merits of it. You can be pretty flexible with how LLCs are structured in terms of management and rights and things like that, and get all the tax benefits of the C Corp status. But it's going to put you into a box with most investors if you do that, of being a little bit outside the box. That said, I mean, I have seen a $1 billion exit for LLCs taxed as a corporation. So it's hard for me to knock something that has worked, when I see that kind of stuff. But I think most companies, even that have gotten started as LLCs, once they're going through different programs and markets, are doing the work to convert into corporations, and that's probably the right move. The industry, these industry numbers are pretty consistent, surprisingly, in a lot of the markets we cover. So without fail, SaaS seems to be the highest number of deals, and then usually biotech, followed by mobile apps and things like that, and then healthcare is kind of its own thing. To me, the difference being there are lots of companies out there, think Hims and Hers, or there are different kinds of wellness clinics that are rapidly growing and exiting, or even going public. So that's kind of its own unique thing. Those companies, by the way, are the ones that are mostly LLCs, I think, and a lot of times it's because they're probably going to exit with less than 5 years if they're really growing super fast. So being a corporation would just guarantee double tax. Consumer goods is actually lower here than a lot of the other markets that we study. So there's, like in Tennessee and Louisiana, for example, there's probably a disproportionately high number of consumer products type of companies and food and beverage companies. It surprised me in St. Louis because there's a long history of obviously giant name food and beverage companies and things like that. So that's kind of the breakdown. Interestingly enough, in a lot of markets, you don't find that many funds necessarily focusing on SaaS and mobile. Every time I hear this in Nashville all the time, is everybody's like, yeah, that's crazy, because my fund does probably skew toward that. Our portfolio tends to sort of look somewhat like the markets, and our idea being that your most likely path to succeed is by going where the numbers are, if you're playing the odds, and that if you're only picking one of these slices of the pie, and especially in one market, you have a very low chance of getting returns. Now, that's not necessarily the case. Like, there are obviously exceptions to that rule, but that's kind of our philosophy as a fund. But those are what the numbers kind of look like in the market. And then we check this like 4 or 5 times at least. The capital raised also sort of looks like it's tracking that, which is also pretty surprising. Because a lot of times you'll see maybe biotech being a smaller number of deals, but a much higher amount of the capital raised. But in St. Louis, unless we've just botched our data, which I don't think we did, that's what we're showing. So, and again, I think this is interesting because one of the points I made earlier was, if you're working in the ecosystem or you're a service provider to these companies, is your strategy aligned with what your market is? Are you taking a top-down approach or a bottom-up approach? Like, I think there's a decent argument to be made that some of this stuff is not a build it if you come sort of situation, where if we just build a facility that's geared toward a sector, it will naturally result in these kinds of clusters forming. It might be that clusters are forming. People are moving to cities and saying, I'm starting my next tech company in St. Louis where it's cheaper to live than Palo Alto, and I'm gonna, do it there, and I'll just have to excel versus my peers, and just be scrappy until I find a fund. I think that's happening. It's definitely been happening in New Orleans for a long time. I think it's happened in Nashville. Most of the funds that are there, and I think this is the case in a lot of places, the funds are sort of focusing maybe where their institutional investors are kind of requiring it. So if you're a fund and you have a large investment from a university or a pension fund, and the idea is that the investment is going to support part of the institution and what it's catering to, then perhaps the portfolios of the funds may not look like the actual market. And so to me, the questions maybe should start arising, like, should there be more support for funds where portfolios look more like the market? Because again, there's more variety of companies to pick from. If you have 10 SaaS companies and they're all doing pretty good versus like 2, maybe biotech or consumer products companies, where are you more likely to succeed? You just have to kind of do the math, look at the metrics of those companies. But I think that's interesting food for thought for all ecosystems that we're involved in. This isn't really surprising. Sorry for my little squiggle there. Doesn't mean anything. But yeah, I mean, the deal activity typically follows populations in all these markets, and in general, right? Like, the Bay Area has 8.5 million people. Missouri has, 6.5 million people total. So, this is just, again, it's a numbers game, right? It's somewhat Moneyball here. So there's more deals in St. Louis than in other places. Usually we look at what Kansas City, Missouri, and Kansas City, Kansas together would look like, but we didn't do that here. We just kind of showed just Missouri. But Clayton and St. Louis are overwhelmingly the center of activity in the state, which probably doesn't surprise you. So,
Can I ask you a question?
Yeah.
Did you separate Clayton and St. Louis out because are you really talking, again, we have lingo here, are you
Yeah.
talking about the county and the city?
This is where corporate headquarters, so it's Clayton, Missouri, the city. Yeah, not the county level. We didn't look at the county level.
Got it, thank you.
Yeah.
Okay. But that St. Louis number is
Wait, let me go
actual
back.
the city of St. Louis?
Like city proper, that's what I'm asking, like, what are we talking about? Like St. Louis, greater metropolitan area, including East St. Louis and Illinois, or?
This is the city, St.
City,
Louis,
St. Louis.
where corporate headquarters are listed.
Okay,
And
so
it's-
if somebody listed their headquarters in Creve Coeur, for example, they're up in the 10% other?
Correct.
Okay.
Yeah.
And this is back from, going back to 2011, so it's all aggregated.
Got
you
it,
know.
okay. Oh, this is,
So,
this is.
If they listed it in
this is
St.
over
Louis
this
in
12
2012
time.
and now it's Clayton, it's still gonna be called St. Louis, so,
Yeah, we'll do like a follow-up, maybe
Yeah, we
heat
can-
map.
yeah.
People, it's like an enticement to get on our email list. We'll do some more stuff. I love these. This is what we'll do. Yeah.
Follow us on YouTube.
Do you think that 13% legislation was high?
Yeah, well, again, I was like, is this their headquarters or is this their registered agent? Because I think everybody's registered agent is like.
No, this is their headquarters. This is where they're listing their headquarters. It's unlikely to be their registered agent. And we double check these too. Like,
Yeah, yeah.
so yeah, some of it comes from filing data, and then we verify what they're doing. But it's not.
But it
Yeah, I don't know.
makes sense. You said
What's
2011.
surprising about this?
St. Louis is a very segregated city,
Mhm.
right? So like when you, like very few, I mean, demographically, like the city is very small compared to the metropolitan area, right? So we designate ourselves, we self-designate ourselves into the county, and then even within the county, West County, South County, North County. And then, so, because Clayton is this little itty bitty place.
Yeah.
Like it's
Yeah.
not very many people for,
But I
for
think
half.
if you're looking at data from 2011 and everybody that had an address at T-Rex.
That's correct.
That's
Yeah,
what I
I
think.
think- well, that's what I was gonna say. I was like,
That's what it-
Yeah.
Cortex,
you're looking at.
Cortex
Yeah.
and T-Rex alone are going to
Yeah.
be
Yeah,
like,
No, but that, yeah, there's
yeah.
some, but yeah, I mean, that's a, yeah, most of the co-working spaces
Yeah.
are in this, that's what I'm
Yeah.
saying.
that's
Yeah.
that's what it
People
is.
going,
That's what's
"This is
happening.
This is my mailbox in T-Rex.
Yeah,
Yeah, got it.
yeah, that's more than likely what's happening.
Deeper than that, you're getting into
That'd be nice to see
territory,
updated
Mike,
data
so we
from,
appreciate it.
Yeah, I mean, like I'm saying, maybe we'll do like a heat map on
Yeah,
zip
we
codes
will.
or something. But I think you're going to see a big heat map over Cortex and T-Rex and a few other spots. But that's what it is. I mean, as work from home increases, same thing. I mean, I guess it starts to continue to look like this because
Yeah,
people,
that's the thing we look at. I think
Yeah.
Kansas City, like, with this 2011, the Kauffman Foundation is putting a lot of resources. That Kansas City number also surprises me based on my experience.
It doesn't surprise me when you're talking about the Missouri side.
yeah, that's what I was going to say.
I know, I thought you said you combined Kansas.
No, I say we usually do in like a follow-up and we look at it as a unified city. But if we're just including the Missouri,
Majority of the activity is on the Kansas side.
I think it would balance out much more if you include both. I agree, 100%. Yeah, there's a lot of activity in Kansas City.
Yeah,
There's-
it makes
there's-
sense like
There's a
Kauffman.
lot happening in Clayton and there's nothing
That's
happening.
what I was gonna say. Clayton is really high, and I think Kansas is really low.
Yeah.
People love these. I love this one. I love these slides too.
We'll have to do one in the last like 5 years, maybe.
It's not like we're territorial or anything.
Yeah, this is another one, right? So I question this, and I still question it. I went through the Tennessee numbers again. I can knock down some, but I can't get it to remotely look like the rest of these. I mean, there's just a lot of really big deals happening there, and there's a so on the gray line, that's the population of the state, and then the blue line is the amount of venture capital raised, and it's just shocking to me. I mean, now they have a much higher population than the rest of these states listed here, but that's just a crazy amount of deals, and they just have some monster deals. I couldn't really exclude a ton. Like when I looked at it, it wasn't going to make a dent in this number. So
Do you have a sense of is the money coming from inside the capital, or is it just the
we didn't track that.
Sometimes.
generational wealth?
Yeah, I think for Tennessee, they have some massive stuff in healthcare, and then they do have a lot of money in the music industry.
Yeah.
So I mean, there are some record label deals, and I include those. Like we represent a number of record labels, and we do a lot of work for musicians and celebrities in their non-music deals. So if they're starting hotels or restaurants or product companies, and I would say like more and more, somebody might tell me, well, you can't include that kind of deal in that. I think you do, because these record deals look like venture deals. They have preferred stock. They have the same profile of investors. Oftentimes you're seeing a mixture all these people in tech like want to feel cool, so they try to get involved in these other deals, and I think you include them. So, but yeah, they just have a tremendously high number of deals, and I think it's a bigger state than like even I realize. I always think of Tennessee as being small, but it's there's a lot of people there.
There's also a lot of companies there who are investing in whatever
Yeah.
they, smaller companies, spin outs, et cetera.
Maybe they're a no income tax state, right? Maybe it's one of
Maybe
those
it's that.
things like Texas and yeah, Alabama is another one that surprised me, but they've had some monster deals, with things like Shipt and stuff like that, and it's also a state that is just way bigger than I think, because I'm on the Gulf Coast. We go to Florida and we pass through all these tiny towns, and just a sliver of Alabama that big. It seems like Mississippi to me in size, but it's not. It's pretty big. South Carolina, there's just a lot more there. There's a number of funds based there from Angel, and then Missouri. Missouri. Probably the other bigger shocker to me was Arkansas,
They're coming for us.
Yeah.
They really are.
Really?
With the Walmart money is dragging people over the state line.
Yeah.
So
There's a lot of interesting funds and accelerators. They've had some pretty good exits too. Louisiana is small, but in terms of how its population size, which is pretty low, is doing all right. What's not captured here is exit value. So like I'm saying, my first client in New Orleans, Lucid, exited for $1 billion. There's another company called Level Set, exited for $500 million. Waiter exited for $300 million at first, went to $1.5 billion, now is valueless. But there's it's interesting, like what when you look at these deal activities in these markets. But I think when you look at these as a whole, which is what we do and I do, there's actually a lot of activity and a lot of money. And every market, the people within them say similar things, and it's kind of by comparing what happens in each of these things, to me, do you see what's going on? I don't think this is like all incentive based, or I was kind of joking about the tax stuff. I think that those kinds of things make a difference, but each state has its own different, tax incentives, whether they be angel investor tax credits or digital media or no tax at all. I don't think you can reduce it to that. And this is another one of those things where in New Orleans we have a I don't think it's enough to counteract our brain drain, but the people that move there are a lot of people that move there from like pretty legitimate tech companies where they have really good experience and they just like the city and the quality of life. And I think probably Tennessee has done a good job. Kind of like if you drive around Tennessee, they're basically trying to recruit California people with outdoor activities and all these other things. And I think they've succeeded, and they've done a good job of creating this, mindset of like it's such a cool place because it's, got the music industry and everything else. So I think it may be those soft things as much as anything, spending a lot of time in all these places.
Communicates to me that we got a lot of work to do.
Well, I think it's all relative, right? So if I'm sitting in Louisiana mostly, I'm doing deals all over the country. I think Missouri's a really good, pretty strong market. But if you're here,
Look at the population to the investment.
yes,
We have the biggest differential of any state that you have on the map.
Yeah.
On the
yeah, that is true.
that doesn't talk, right?
No, but it means we're gonna have to work harder, right?
Or we get our,
That's right. That doesn't talk.
So and one of the things.
out of our deep pockets and.
One of the things to do, this is the case for New Orleans. New Orleans is a very small city too. Even it's a smaller metro area than St. Louis. Because it accounts for such a big portion of that, that's the selling point. Is you say, actually on a per capita basis, if you're smart, maybe you move to St. Louis or New Orleans because you're going to shine in these places. You have to prepare people that are looking at these markets that it's not all roses and sunshine. And because there's a limited number of funds in any given city, you may or may not fit their mandate. If there's a fund here that says, I have to invest in 7 ag tech companies, and you're one of 50 SaaS companies, you have a 1 in 50 shot of getting funded. So that's why there has to be a plethora of different funds with different strategies and people serving things, and there has to be calibration. And most importantly, I think these smaller markets with a lot more in common culturally and economically and historically. Like these are all, New Orleans, St. Louis, Memphis, Nashville. These are all places that have had long-standing trade routes and have created some of the most important, cultural and technological phenomenon in America's history. We need to start doing more business together and looking at more deals. I know that's happened already. I mean, we've come really close to investing in a bunch of St. Louis deals. St. Louis funds invest in New Orleans companies, so it's happening. Same with Tennessee. One of our portfolio companies is a Nashville-based company. But yeah, we all have work to do, and I think some of it's policy related, but I think the vast majority is probably perception related. We have to counter the perception that there's no funding available, because there is funding available, and we have to remind people that there are the same things here in these places as there are other. Like, you can still go and hike in nature. Yes, we're not blessed all with 70 degrees of no humidity year round.
Though it's beautiful here this week.
Yeah, but it's pretty good, notwithstanding. I think people want, there's a lot of like lifestyle things that I think people want that, we've probably got to highlight in our smaller communities. But overall, I'm pretty optimistic.
The elephant in the room. It'd be nice. It would be nice, not nice. It would be interesting. We call it the elephant in the room. It'd be interesting if you overlaid education rankings and crime rankings for these cities, overlaying that.
Yeah,
because
for sure.
We've got some issues that yes, we don't have low humidity and beautiful mountains to hike. We also have other things going on here that people don't want to bring and raise their kids here for.
It's very true. I think those are true. This was really great. And so we have a bunch of time, I think. We have at least 15 minutes, and we'll be here for a while. I'd love to talk more, ask questions, get feedback. We could always improve. If you follow us on these things, I promise we'll get some of these other things y'all have asked for out and do a little series, a follow-up further series. We even have deal data. Like, we track to see like what kind of terms are happening in St. Louis and other markets. And I have some observations there too. Like, one of those is that historically, the deal terms in St. Louis have been much more investor favorable than other markets. So I see things like participating preferred stock happening way more frequently in this market than, say, my market. And I think there's lots of historical reasons for that. But redemption rights by investors, where investors get to basically put their stock back to the company, that's also much more common here. Those are kind of more East Coast terms. I don't even think on the East Coast they're all that common anymore. But anyway, interesting stuff, and we have lots more follow-up. So what other questions or things can we do better? Yeah, go ahead.
1 second. We're going to get the mic to you.
This is super helpful, by the way. Thanks for all the data. I'm curious on the, for Missouri capital raised, do you have a sense of early stage, mid stage, late stage, and a breakdown of that?
Like we said, we don't have the specific breakdown, but I do get the sense over the last few years, like since the 2019, 2020 era, there's been a lot more late stage, a lot more early stage, a lot of kind of bridge rounds. There have been some really good Series A's, but there have been fewer than we saw back in like 2016, 2017, 2018. So we'll get some specifics on that and get it out to everybody, but that's just my general sense of it from going through the data.
Take some notes on here, these two. Yeah, we can figure that out pretty easy.
Yeah, we can figure that out pretty
We
quick.
have it. We just didn't get ready for that here.
So, you mentioned or implied that South Carolina had more angel investors. Is that a correct?
I don't know that. I didn't mean to imply that they had more angel investors. They do have a number of funds and angel funds I'm aware of.
The question was, let's say I need angel funding. Do I have to be in the region where I'm making a pitch? Does that give me an advantage? Should I move to South Carolina? Should I move to Charleston?
I don't know. It might. I think it depends on what the investors in that market, and I don't know enough about the market to be honest with you. But I would say, let me answer the question more generally. Number one, I think funds more and more are recognizing some of the inherent numerical limitations of an only in my backyard investment strategy. In other words, again, 2011 to 2020, 2019, I rarely saw a fund in St. Louis looking at a company anywhere else. That has changed. same with Investors Louisiana. So I think more and more investors are looking at a broader regional spectrum. I even think there's connections between some folks in St. Louis and North and South Carolina at this point. So I think it's becoming more possible to raise money outside of the city that you're located in. But I think whether or not a company moves to a particular market, I think they need to really research the funds that are there and determine they have an outsized chance of getting funded by that group. So I don't know. I don't think, I could be wrong about this, unless somebody's moving to a cluster to be part of that cluster, I don't know that there's a lot of migration based on fund investing habits, because you never know. I mean, there's not a high chance you're going to get invested in by any one single fund unless you have some connection there or experience with that fund that guarantees it. So if I wouldn't move to a place because I'm going to get that fund to invest in me. And I don't think, by the way, being in any of these markets outside of Silicon Valley, I mean, it used to be harder to get money from East and West Coast investors, but the vast majority of our clients that get through seed end up with funds in Texas, California, and New York. Without, that's not even a thing anymore for the top performing companies, I don't think.
I also think the last time we pulled those population venture data numbers, I remember South Carolina being surprisingly low as opposed to surprisingly high. And I think, you see it nationally, like there was a national report that came out that said there's more, $50+ million deals nationally than there have, been in 10 years. And I think we saw that in Missouri, look at how high the capital is. We saw it in Louisiana this year. I think if you look at South Carolina and Tennessee, you're going to see the same thing. And I think it's maybe a function of population, how much bigger those big numbers are. So, like Mark said, I think you want to do the follow-up homework.
Good morning. I'm going to stand up so you can see. I have actually two questions. Number one, I would like to talk about the cycles a little bit. So I've also been doing some research on deals and the flows. So as I go from, 1 year, you see a lot of angel going to early stage, then late stage. What do you see is a common cycle for, okay, so this year we're in, late stage, so next year we're going to be an angel. So just to give a broad perspective. And then the second question that I have is, I've been looking also at the different types of deals with which technology is being looked at. So the ones that you've shown are, pretty much in line with what I've also been seeing. Mm-hmm. The question that I have, though, is I want to know what's up and coming. Yeah. I know what's already here. I know what we're doing. But I want to know, what are you seeing as a national trend for types of companies that are now kind of trying to break in?
Yeah, I would say the answer I give here is probably more anecdotal. You may know the data better, but I'm seeing more, I'm seeing more, or I'm seeing companies get funded more that maybe are not historically traditional venture capital. So there's maybe an online and offline component, and I see investor appetite for this more than ever. Whereas before, everybody wanted to invest in just tech, software, and things because it's scalable. And I think I think the common belief here is that there are just fewer opportunities there as more things have come online in the world. So the opportunities in that sector are, things in the industrial realm that still have been slow to adopt software for certain things or certain industry-specific solutions. But I don't, I just don't see pure only tech plays happening as much going forward. I think there's also fewer acquirers. Everyone's complaining about this, right? The FANG stock companies pretty much dominate the ability to acquire any companies, or and they're just not doing as many deals. So this is a common complaint in Silicon Valley as well. I think consumer products and e-commerce is going to be a growing category because the barrier to entry is a bit lower. And although those companies some of them are struggling quite a bit right now, I think that long term they're going to still be pretty attractive. It's a pretty liquid market for investors, so there's a number of acquirers for those kinds of companies now, whether they be Amazon or other e-commerce aggregators, or lots of different roll-up strategies. I think deal volume is probably going to go way up. I don't know when, but there's no way that all this SSBCI money going into these funds and new funds and people getting laid off, all these combinations of things, I think once dust settles from like some pretty major disruptions of COVID, an election cycle, possibly a commercial real estate collapse, I think things will shake out and there's going to be a lot of deal activity. I don't see how there couldn't be, unless that money just gets returned. And nobody's returning that government money. So, I
But
don't
I
know.
also want to think that sometimes that money needs to be matched. And so
Yes,
we can't
yeah.
have VCs sitting on the sidelines going, oh, there's all this federal money going into the states. We're just going to sit around and wait for them to de-risk things for us. That's not how this works.
Yeah.
So it's getting, the matching funds off the sidelines as well.
Yeah.
It's going to be key to actually deploying millions of dollars.
Yeah, well, and that's sort of what I've seen a lot of people that have gotten the allocation letters, but they're still fundraising. And how strong the commitments are at the end of the day will be what determines this. Because, there are a lot of people that, could probably, those capital commitments need to be funded by private investors. So I think that's a driving factor. But I do think that's creating a little bit of like lower deal activity. Because how much have y'all deployed of your fund, for example?
Mark, I just wanted to point out that we do have 2 questions.
Okay, sorry. Yeah, who else? We had some other questions. I'm kind of getting. Yeah, sorry.
Hi. So for a first-time founder who's never exited, who has a product that's launched, who's looking to hold those customers in, but is limited on time. So you talk about a safe.
Mm-hmm.
Is there like a standard set of terms that should be followed? I'm pretty sure Y Combinator is like 500,000, 7% of the company has 6 million capital.
Yeah, I don't know what their current thing is, but
Total guess.
yeah,
Is there
I would say the standard safe Y Combinator. I don't know if they're still using it, but it was a post-money. It was called a post-money safe. I think we've done no deals under that.
Done in a long time.
So standard is kind of different for everybody. That's one of the reasons we look at this stuff. Like I know in Louisiana, we're involved with more deals than anybody, and we do 0 of those. Are there other groups getting those? Probably. But, and you gotta, if your market is different, like if everybody here is doing a post-money safe on similar terms of Y Combinator, you just sort of gotta go with it, probably. Unless you're like exceptional and there's so much FOMO, you call the shots, which happens again. So yeah, I think Series Seed and safes are the most common instruments these days, without a doubt, for early stage companies.
And we have some tools for early on companies too on Series Seed versus Safe and
Yeah.
how you can figure out what that looks like down the road. And
But I think, what instrument people prefer depends. I think one other thing to think about on that note is like, where is your money likely to come from? So in Louisiana, for example, if you're in the startup world, if you're like at an event like this, you know what a safe is, you're comfortable with them, you like them. But if you go to the wealthy angel that doesn't spend any time at these, of which that's probably the majority of money getting invested, I would say, then they don't know what a safe means. Like they want to know, all right, I put in $100,000, how much of the company do I get? And then if you have a safe, you go, well, I have to calculate it, and there's a thing, and some people get turned off by that. So, one of the key things about a successful fundraising strategy is knowing your audience and really putting a list together, understanding what is going to resonate with the majority of them. You're not going to get 100% of your targets. You have to get as many of your targets as possible with the lowest resistance possible. So I think that's the key to making this work. Like if you're only going to talk to investors that are part of the world that we're in here at these kinds of events and conferences, then you're going to stick to the program. But not everybody can rely on that. right? Because of those numbers. In any given year, you're 1 out of 90 companies, and within that 90, probably 30% are late stage, 50% are early stage, and 20% are like mid or mezzanine. So like you've got to kind of crunch the numbers and say, all right, I'm 1 out of 30, therefore, and then out of 30 companies, this one fund historically only invests in how many of my kind of companies. So whether or not you start with a safe depends on, are they the likely person or not? If they're not, you've got to go to friends, family, other kinds of high net worth folks, and they want a more straightforward, simple instrument, then that's what you got to do. Notwithstanding what people are going to tell you at something. So I think that's the key, is really narrowing and being specific.
Thank you.
Have time for the last question here.
I'll try to be quick. First of all, thank you for the charts. I'm an engineer.
Thanks.
I love numbers. The charts though, is it one home run or lots of deals? Do you know what I'm saying? Like had a chart that had population and money raised. So
Yeah.
my thing with Silicon Valley is money means different things there. Like my sister's house that is smaller than mine is worth several $1 million.
Right.
The
Or
street-
was, at least.
It's very different if you just have a home run in Louisiana and it's that bar, and it's one company that raised a ridiculous amount of money, or if it's 500 companies that raised that amount.
Well, yeah, that's a good point. So I did talk about exits, but these aren't exits. If these were exits, Louisiana would look awesome. It would look the best probably, because we have a small population, but we've had a crazy number or crazy amount of money in liquidity from those exits. But yeah, what we're tracking for is the amount of money raised by companies from investors and the amount of deals, like of those kinds of deals. I do have exit data because I use it when I pitch investors in my fund, and I show them exactly what you're describing, that your odds actually of having a really good exit in these other markets are higher if you take the right strategy. So I think it's more often than not, it's that there are more of those solid return exits and less often that there's one gigantic one that does everything. So my theory and my research shows that there's just better liquidity with the right kind of investing strategy in our kinds of markets, which is, by the way, 100% contrarian to what you'll read from Silicon Valley folks, especially some of our more megalomania-leaning, like outspoken fund leaders who are like, I'm investing in global massive trends and nothing else even interests me. Well, that's a dumb investment strategy in the rest of the world. In general, it's a dumb investing strategy. People don't know, I shouldn't say no. Very few successful investors in life make like singular bets on one thing that will become massive. Sometimes portfolio returns look that way, and if you're trying to put billions of dollars to work, it might be your only option to invest in a large number of companies that have like an insane, like it's either a gigantic thing or it's nothing. If you take that strategy outside of an area like that with a smaller amount of money to put at work, I believe you will lose it all. That's my personal belief. I could be wrong. We'll find out. My fund returns look, pretty good. So, anything else? This was really great. We'll be around. I think we got to probably get going for the next speaker.
Thank you so much. Well, everyone, let's give Claire and Mark a round of
All
applause.
right.